Hello, welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks advancing while Wall Street waited for hints from the Fed about policy cuts, plus gold rushing ahead with its record-breaking rally. More on those top stories in just a moment, but right now, just an hour to go until the closing bell. Let's take a look at the major averages. The Dow basically flat here. The S&P 500, though, your broad gauge, is up about 0.5%. And you on the tech-heavy NASDAQ is up about 0.9%. Let's welcome in senior markets reporter Inez Ferre. We also have data and markets editor Jared Blickery joining us to break down all the headlines. Jared, my friend, let's start with you on the trading action so far.
Let's start with the major indices. We got the Dow, as you said, just barely positive there, but the NASDAQ has been leading higher most of the day, up about 87 basis points, 0.9%. And you can see we started out the day in the green, added onto those gains, just slightly off of the highs right now. S&P 500 up a little bit more than half of that. And I do like to show what the small caps are doing. And indeed, they are up even more. Well, they're not right now, but they were up more than the NASDAQ earlier. But right now, they are up about 0.75%. And by the way, they were leading to the downside yesterday, and yesterday we had a little bit of a tumble, but not today. And here we have the 10-year T-note yield. That is up 1 basis point to 4.12%. 30-year trading about where it was yesterday around the close, and the U.S. dollar index up just slightly. And Inez Ferre here got you covered on gold, but I'm going to cover digital gold. Bitcoin climbing back towards those record highs from a few days ago, 123,614 right now. In sector land, we got tech leading the way, so all is normal here, up 1.38%. The cyclical's doing fairly well today. Industrial's up 0.75%, materials up 0.5%, utilities up about the same amount as well. All four of those sectors outperforming the S&P 500. To the downside, we got energy leading, followed by real estate, staples, communication services, and financials. All of those in the red right now. And here's the NASDAQ 100. We got a few standouts. AMD up 9%. That has just been on a tear. That's good for another record intraday high there. NVIDIA up almost 2%. Amazon up over 1%. Couple losses here for the big guys. Alphabet down 0.4%. Microsoft is just fractionally negative right there. But both software and semiconductors looking pretty strong today. Here's the semiconductors, the chip stocks. Already talked about AMD. Micron up 5%, it looks like. So is Marvell. And just drilling down into software, and we're going to leave it off here. We got Oracle, Shopify, and Cisco, Pan W2. Each of those up more than 2%. Snowflake up more than 6%.
All right, thank you, Jared. Well, gold continues its record-breaking rally. Senior markets reporter Inez Ferre joining us here with the latest. Inez.
Yeah, that's right, Josh. We are seeing gold at record highs again. It's been making record after record. We've seen record inflows over the last quarter into gold-backed ETFs. We've seen central bank buying, the Fed easing. Those expectations have sent gold higher. And we've also seen a downtrend with respect to the dollar this year. And Wall Street is calling it this debasement trade, so to speak. That's where you see really mounting government debt all over the world, really. And then the way that governments get out of this is by printing money. And so that's part of the trade, why you're seeing investors going into gold, other assets, digital gold, all-time high for stocks. But does this really mean that this is a swing away from the dollar? And that is, at the margin, you've had strategists that have been saying, yes, this is investors trying to get away from the dollar, central banks trying to get away from the dollar. But there's other things that are also at play here, and that is, if you see an allocation away from U.S. Treasuries and into gold, if this is a structural change that is happening, because you have some price targets out there from JP Morgan talked about this, I believe Goldman also talked about this. Even if you see a small pivot away from U.S. Treasuries, that could have an outsized impact on gold prices just because of the sheer size of the U.S. Treasury market. So if you see investors investors, and there's been a lot of questions about getting away from this the 40% allocation in bonds, maybe diversifying into gold, into other assets. So if this is a structural change that is indeed happening, that you see central banks swaying away from treasuries, investors swaying away from treasuries, then you could also keep seeing gold rising in this scenario.
So gold is dominating headlines right now for good reason. It's glittering. If I'm listening to this right now, let's say I'm a gold investor, what are the risks I should be thinking about, at least near term?
Well, I mean, the big risk is if you see an upside in the dollar. But mind you, keep in mind that in the last couple of days, we actually saw the dollar rising a bit, and you still saw gold going higher. But if you see a very meaningful rise in the dollar, then you could see a sell-off in gold. Of course, a big catalyst that happens, and you see a huge market sell-off, you could also see a sell-off in gold in that scenario. If the geopolitical tensions, if you've got the war in Ukraine that ends, the Middle East tensions that end, that could also prompt a sell-off in gold. But in the long term, I mean, this does appear to be that there is a shift that is investors favoring gold as a sort of store in value. You really have to ask yourself, is it gold that's going up, or is it the value of your currency that's going down?
Final question, how crowded is this trade at this point?
I mean, you've got strategists that are talking about that this is a crowded trade. I mean, this is overextended. You are looking at gold that's up 55% year to date. Sean Farrell from Fundstrat has some interesting charts basically showing that when gold goes up, you see Bitcoin going down, but then when Bitcoin goes up, gold's... So he believes that there may be a shift that starts happening where you go from analog gold, investors start going into digital gold in that respect.
All right, Liz, thank you. Appreciate it.
You're welcome.
Well, the Fed is out with its meeting minutes from its rate cut decision in September, and Yahoo Finance's Jennifer Schonberger joining us now with the details. Jen.
Hey there, Josh. The markets got what they wanted, more rate cuts ahead. While there was division at the Fed's last meeting about whether to cut interest rates and by how much, most agreed that they would cut rates further this year. The minutes read, quote, most judged that it likely would be appropriate to ease policy further over the remainder of this year. Now, while most officials thought it was wise to cut rates to guard against downside risks to the job market, there were a few officials who could have voted in favor of holding rates steady because they think that progress on inflation has stalled. And on the other side, there was one participant who argued for that 0.5% interest rate cut, unmistakably Fed Governor Stephen Miron there. And interestingly, while Fed officials saw downside risks to the job market rising and favored that cut, a majority of Fed officials are still very much worried about inflation. They see it moving in the opposite direction of 2%. There's still uncertainty, they say, about the impact of tariffs on inflation, and still a risk that the impact of tariffs on inflation could prove longer lasting than just a one-time increase in prices. On the other side of the Fed's dual mandate, when it came to the outlook for the job market, it was interesting to read that most officials do not see a, quote, sharp deterioration in labor market conditions. They noted that labor market conditions would likely be little change or would soften modestly. They really see a lower immigration fueling these changes and uncertainty about policy that has put a hold on hiring at this point. And lastly, just want to point out what officials said about the balance sheet. They are continuing to monitor money market conditions closely to make sure that we still have ample reserves in the banking system. To me, I took that as a signal that perhaps the Fed is looking at how close they are to pausing their balance sheet runoff. When I asked Fed Chair Powell about that during the press conference, he seemed to think that the Fed was content with the way things are running right now with that balance sheet. Josh?
All right, thank you, Jen. Well, to help us put all of the market and Fed news into perspective and what it means for navigating your portfolio, Melissa Brown, SimCorp Managing Director of Investment Decision Research, joining us in studio. Melissa, great to see you as always. So let's start there with the Fed minutes. Here's a line. Most judged that it likely would be appropriate to ease policy further over the remainder of this year. They also did show, though, majority of participants emphasize upside risks to their outlooks for inflation. What did you make of it then?
Well, I think they're really caught between a rock and a hard place. You see the term stagflation thrown around a lot more. I think They have a very difficult choice to make. There's a lot of outside forces driving inflation higher, and so they really need to worry about that. But it's also, clear that maybe the economy is starting to falter.
So how much do you think they ease? What would you pencil in?
I would, because they have this, they have the dual mandate and the dual problems. I would say, 25 at the next meeting, probably not more, but I think would be a big surprise. I also think investors would really become worried if they actually did a 50 basis point cut, because that's saying there's something that they're seeing in the data, if they can get the data, that perhaps the rest of us aren't seeing.
You also say this, I thought was interesting, Melissa. You say this is still a bad news is good news market. Explain what you mean by that, and how long you think that dynamic persists.
Well, so we've seen on days when what might be perceived as good news, like stronger GDP revisions for the prior quarter, and strong GDP for this quarter, markets go down. When you see what might be perceived as bad news, higher inflation, higher PCE, the market goes up. So it is a bad news is good news is market. I don't see what's going to change that until there's maybe some catalyst that, that there's a decision, say that this AI trade has been overdone or something that really turns bad news into bad news.
About that AI trade, what do you make of all the focus on it? Because it seems like it's all we actually talk about at this point.
I mean, it's funny. It reminds me of the internet in 2000.
I mean, is that a worry to you?
It is a worry to me because we're looking at very high valuations. You really have to have everything go perfectly for these companies, which it might. But as we saw with the internet, things were great, then they were not good for internet companies for a while until the actual promise of the internet came about. You could potentially be saying the same thing with AI, with potentially more issues like AI taking over entry-level jobs.
Although when I bring up valuations, what people say to me on this, sitting in that very seat, Melissa, they say, it's not a market timing tool. What am I supposed to do with that?
And that's true. It's not a market timing tool. What it does tell you is that when that catalyst comes, you're going to have a bigger fall because it's falling from a higher height.
Do we appear set up here? You look at sentiment, you look at fundamentals. Does it feel like we're setting up here for a pullback or correction? I
think not yet, because there's still a lot of cash on the sidelines. The evidence has been that investors are coming in and buying the dip. So,
and let's say we saw a dip, would you expect that same investor reaction? They'd move right back in?
I would expect that same reaction. Investors have just been, primed for that's the reaction to have. And so that's the reaction that they're going to have. If they have the cash, they can put it in. Particularly if you've missed out on a lot of the move up already, you don't want to miss. You have FOMO. You don't want to miss any more. I'm not sure that that's over the long term the best move, but I think we're going to continue to see that for some time until something really fundamentally shifts.
Let me ask you about earnings season on deck. I'm curious to your expectations there. What is earnings growth? What do margins look like?
Well, so far, from what I can tell, earnings growth is expected to be about 8%. And actually, sales growth, revenue growth is expected to be lower. So that implies margin expansion, which is with inflation higher than expected, consumers pulling back. It's hard to imagine how you're even going to get that revenue growth, and particularly how you're going to get margin expansion.
What about government shutdowns? Have you all done research on that? How worried I should be? Because I'm always told, you're told as investors, you don't get worried. I've had strategists come on here. They say headline risk. It's not bottom line risk. You look through it. Is that true?
Certainly our research has done that. We've looked back to the shutdowns back to 1982. Markets, sometimes go up a little, sometimes go down a little, but there's not big moves.
Is there anything different this time, Melissa?
The only thing that I can see that's different this time is the threat that maybe some workers aren't going to get paid at all. So I think you can always assume that eventually spending is going to resume. But if workers don't get paid, or if they get laid off, that potentially is a bigger risk than we've seen in the past.
Melissa, always great to see you, especially on set. Thank you.
Thank you.
Coming up, Elon Musk's AI company gets a big infusion of cash from some very high-profile investors. We're speaking with an expert in the space. Tariffs driving a reduction in global operating profits for automakers to the tune of $30 billion. We're digging into those losses. And spirits maker Constellation Brands navigating a tough economic climate and changing consumer tastes. We're speaking with the company's CEO. Those stories and more. Stick with us. Big money pouring into AI, and this time it's Elon Musk and NVIDIA at the center of it. Bloomberg is reporting that xAI is raising up to $20 billion, with NVIDIA investing as much as $2 billion into Musk's AI startup. For more, we want to bring in here John McNeil, DVX Ventures CEO, co-founder of Vista Shares, and former president at Tesla. John, good to see you. So reports showing Jensen Huang doing more investing, John. NVIDIA apparently investing $2 billion in xAI. What do you make of that, John, that headline? And what, if anything, does it tell you about that mega AI trade and trend?
Hey, Josh, I think what it says is that NVIDIA and Jensen are deploying their balance sheet in very productive ways. I think there's a lot of VCs that would love to have Jensen's returns right now. I think he's up like 5 or 6x on CoreWeave. He's up similar amounts in their investments into OpenAI. They've invested into xAI along the way, and Wave, Anthropic, others. So he and NVIDIA are building a kind of an envious portfolio that's generating the combination of great returns for their balance sheet, but also really seeding customers purchasing ahead of where their demand is.
Let me ask you, John, with all this money Musk is raising here, does it change at all the competitive landscape, with OpenAI, Anthropic, Google?
I think what's happening is with the large language model producers, so OpenAI, Anthropic, xAI, they are kind of each of them in a race that kind of gets rescored monthly as to who's at the top of the leaderboard. But they're all generating very similar now results across general areas of expertise. But when you look particularly into specific verticals like coding, xAI is making dramatic gains and are coming up at the top of a lot of folks' leaderboards. So I think the main story here, it doesn't change. It takes a lot of capital to train these large models. And we're seeing some parity now amongst the very, very largest of these large language model companies.
Folks do note, John, I'm curious to get your take on this, what is referred to now as this kind of web of circular AI deals, meaning NVIDIA, it's going to invest in OpenAI and CoreWeave and xAI, right? But also NVIDIA will provide product. It'll provide chips, right, to the companies. Is that any kind of concern, John, for the AI trade? All these interconnected deals?
I think it symbolizes where the industry is at. You've got customers that are burning a lot of capital, that are raising a lot of capital, and they're growing like crazy. To have OpenAI approaching $14 billion in revenue is incredible, given how young the company is. So you could argue they're not far away, maybe several years away from turning the corner on profitability, but they are going to need to buy chips and infrastructure on the way to that profitability. And again, like if NVIDIA can provide them with the financing for the chips and make 4 to 5 times their money, that's a pretty good outcome for NVIDIA shareholders.
How, John, should public market investors be thinking about the smart AI opportunities right now? I mean, is it still, John, in your opinion, hey, stick with the hyperscalers, stick with the chip giants, or no, look for the next waves?
I think, we tend to look at the top layer of the stack. So the bottom layer of the stack is chips, and then there's infrastructure on top of the chips in terms of AI data centers. There are LLMs, the large language, very, very large hyperscalers that are training the large models. And then there's the application layer. And the application layer is when companies now start to deploy these. And you see companies like Cursor, we've got a company called Domify, companies like Physics AI, others that are starting to emerge. They're solving industry-specific or task-specific problems, and they're starting to generate real revenue. And so I think for the private investment market, we're spending most of our time at the application layer. Those in the public market have a chance to play both the chip layer and the AI infrastructure layer in terms of data centers. And we introduced at my firm what's been now year to date the highest performing AI infrastructure fund. It's ticker AIS, where we are actively managing the build, those that supply the build of the AI data centers. And we're doing that in an active way by really staying on top of, through our advisory boards, the tech that's changing that's going into these AI data centers. That active management has led to the results year to date, which are that we've got the top returns.
Finally, John, you used to work at Tesla, so I feel like I'd be remiss, John, if I didn't ask you about this. Musk did reveal these cheaper versions of the Model Y, Model 3. What do you make of it, John? I'm just curious to get your take. What do you think it could mean for growth and margins at your former employer?
Well, I think we all know that the market for cars gets multiples larger as the price comes down. In other words, the largest market for cars is between $20,000 and $30,000. It's a huge sweet spot. It's also large between $30,000 and $35,000. And so you're seeing product in that market space, like the Chevy Equinox, which is now the number 2 non-Tesla selling EV, just out of nowhere. It's exploded because it's a $35,000, $34,000 small SUV that's got plenty of room and plenty of range. I think in Tesla's case, this is what disruption looks like when a company starts to really mature. It's not disruptive, it's kind of iterative change. I think investors were looking for them to come down into that $25,000 to $35,000 range. And I think what Tesla's signaling is they're willing to iteratively change the product down to, say, $40,000, but they're putting all their capital in 2 other businesses, autonomous driving and robots. And so I don't think we're going to see disruptive change out of Tesla's car lineup, would be my prediction. Because they're actually maturing and pointing their capital at 2 different opportunities now.
Now that $7,500 tax credit, John, has gone bye-bye, I am curious finally, just to get your take. What do you think demand for EVs looks like here for Tesla and the broader industry?
I think we get the advantage in this market, the EV market. The other areas of the world are ahead of us in adoption, both Asia and Europe. And so you can look at case studies and kind of find the answer to that question. France and Germany 2 years ago retired their subsidies, retired the leasing benefit that they had. So it looked a lot like us until last week. And what happened is that the EV market continued to grow. There'll be a dip for sure in this quarter, I would imagine. But over time, their EV markets continue to grow. I think when we see in the U.S., roughly 10% of car sales this last quarter were EVs, another 12% were hybrids. So that's getting close to 1 in 4 cars sold that are electrified in their transmission or in their propulsion. And what that means, I think, is that's a market that's ready to stand on its own. So it's probably not the worst thing in the world that the subsidies come off, but I don't think that's going to cause a nosedive in demand. In fact, I think you and I could talk a couple of years from now, and we may see that the industry has grown if it looks like the rest of the world.
John, we're always lucky to have you on the show. Thank you.
Thanks, Josh.
Well, the net effect of President Trump's various trade wars are creating a dark cloud over automakers, and Yahoo Finance's Praz Subramanian joins us now with a closer look. Praz.
Yeah, Josh, the hits keep coming for the auto industry and Trump's trade war. Moody's estimates that the hit to the automakers' operating profit this year from tariffs alone will be a staggering $30 billion. And this includes the effects of the framework trade deals between the U.S. and the EU, as well as Japan. Now, mitigation efforts like raising prices and reducing options in cars, you heard that with Tesla, right? Can only go so far to help. Moody's said, leaving only capital-intensive options like localizing production and moving final assembly to the U.S. We did an analysis at the end of Q2 where we found around 11.7 billion in tariff costs to date. So it seems there is still more pain to come in the back half of the year, unless, of course, tariffs are reduced or some sort of new plan is put in place to bring those effects down.
Are there certain automakers who you would argue are relatively better positioned than others to just navigate all this?
You know, you could argue that Ford is better positioned. They make about a significant amount. I think slightly over 80% of their vehicles are made in the U.S., right? But I need to check that, but around that, because they have a lot of U.S. UAW workers here. But they also still do import the very popular Maverick from Mexico. So they're taking a tariff hit too, and CEO Jim Farley's talked about it, how it's sort of, I think he told Brian Sozzi that it's been hampering investment in this country because they have to pay all this money for tariffs, right? Companies like Toyota, you know, they build in the U.S., but they have a huge exposure in Mexico as well as Japan. They're paying, I think, the biggest tariff bill of any of the automakers there to date. So those are the two companies that are sort of the two end points, you know. GM's in the middle somewhere, Stellantis, of course, in the middle somewhere. And then, you know, the Germans, you know, they're everything's from Germany, right? So they have a lot of difficulties there with the 15% tariff, which is the framework. It's not fully signed yet, but that's what I supposedly is happening starting on August 1st. So.
All right. Thank you, Pras. Appreciate it. Well, coming up, investors may need to heed caution as we watch indices soar. We're talking to an options expert on what you need to know. Stay with us. Stocks have been seeing some gains so far in October with the major indices reaching record closes. However, our next guest outlines why there is reason to be cautious and what that means for traders. Bob Lang, explosive options technical analyst, joining us here now with the Options Playbook, sponsored by Tasty Trade. Bob, great to see you, especially on set, sir. Let's start here. So the VIX perking up, as it does tend to do this time of year, right? How do you play that, Bob? You know, are you concerned enough to buy protection on the general market?
Well, I look, Josh, great to be with you. So I look at volatility in terms of time frames, right? And when the market's been up for 7, 8, 9 months of the year, like it is this year, it tends to lead to bullish behavior to the end of the year. And when that happens, we usually see a suppression of volatility. Now, the VIX is hovering around 16, 17%, which is a little bit lower than normal. The average VIX is about 19, 20%. But it's a little bit lower than normal. It's really feeding into more money coming into the market. Lower volatility tends to make people a little bit more relaxed, a little bit more aggressive into the markets. I think that can be a little bit worrisome, especially since we're worried about some uncertainties coming out here, and anything could hit out of left field, you know, whether it's tariff related or whether it's AI or whether it's something else or some earnings shortfalls coming up the next few weeks. I think it really behooves most people to have some protection on, and either buying volatility or else you're buying puts. Options are very cheap right now. With the VIX been at 16, 17%. So I think that's
your bottom line is some caution is warranted here.
Absolutely.
Okay. I want to talk about AI as well.
Yep.
Lots of hot talk about an AI bubble from, or some very well-respected investors saying, "Hey, they hear echoes of 1999." What's your take on that,
Josh? You know, there's always a bubble going on. There's always a bubble somewhere. I go back to the late '80s, right? There was a bubble in biotech. In the late '90s, there was a bubble in .com names and technology.
Does the bubble have to burst for you to know there was a bubble?
No. In fact, actually, you know what? The people who identify bubbles are the ones who actually are not into it. I was in the bubble during the late '90s and the .com, and I was loving it. It was great, making lots of money. And I'm sure right now, if there's a bubble going on in AI, a lot of people making money. Are they complaining at all? Absolutely not. So, you know, it's only at the end of the ride that people are getting upset and disgusted about. Look, I mean, there was some talk from Paul Tudor Jones the other day.
Sure was, yeah.
Yeah. I think yesterday he said, you know, we're in a bubble right now, similar to we were
99,
in
right?
99, 2000, and he did reference the period between October of 1999 to March 2000, where the Nasdaq went up 80%. Well, I remember that time, and I remember that a lot of short sellers got blown out of the water then during that 6-month period. So, you know, I think you just have to keep it in context and keep the reference point is there, of course, that when the market blew up and the Nasdaq dropped 72% from the highs in March of 2000 to 2001. So you do have that reference point there, but I do think that we really don't have to fear the fact that we're in a bubble right now. It's just make money as you can.
Let's get to some trades. Sticking with AI, talk to me about Google.
Google. So this has been a stock that's been one of my favorites over the past few months, and it's up something 70% since the lows in April. It's kind of consolidating right now. I do like the chart here. If it gets above 250, 253, it's got some room to run. So I'm looking at maybe like a March call for Google, maybe even to January, a little bit shorter term. But I'm looking at a call maybe paying about $17 in March, and if it gets past those certain levels, about 253 to 255. This stock's got some leg to run, and I think that in 2026 this is going to be the year of Alphabet or Google. I think with a positive business environment, you've got lower interest rates coming in over the next couple months and into 2026, and then a deregulatory environment, and also we've seen Google come out and settle with the English government, and they got lawsuits with Europe, and I think even in the United States. They're going to be settling these lawsuits, and it's going to be a tailwind for the stock.
And OpenAI, they're not going to come in and just take search, Google's bread and butter?
I think that Google's got a real good foothold in this. And look, they're number one in search. They continue to expand that footprint in search. And there really is no competition for them. And I think going forward, so OpenAI is going to be some competition, but there's also other competitors out there too. There's Microsoft, there's Amazon, there's Apple too.
Speaking of Microsoft, you got a trade there too?
I really like Microsoft. It's created a nice little bowl-shaped pattern here, Josh, and it ran up. It had an unbelievable run in the summertime, came back down, made a low here, and it's making higher highs and higher lows, which is our textbook definition of an uptrend. And I do like Microsoft going into earnings season. I think that it's going to make a run past 550. And if it gets past that 550 marker, which is the old high back in early August, I think it's got to run to 600.
Bob, always great to see you. Appreciate your time in those trades, sir.
Thanks, Josh.
Constellation Brands finding itself in the cross currents of price-conscious consumers and economic headwinds. Yahoo Finance's executive editor Brian Sozzi had a chance to speak with CEO Bill Newlands on the challenging state of the spirits business.
One of the things that we're finding in our research, Brian, is that the consumer is concerned. And it's true across not only the Hispanic consumer, but in the broader market as well. 80% of consumers are concerned about socioeconomic issues, and 70% of them are concerned about their personal finances. The way that has generally played out, particularly with the Hispanic consumer, is they're going out less, they're going to bars and restaurants less, and they're having less occasions at home when they would consume our products.
Bill, why do you think they are going out less?
I think there's concern. I think, as I said, there's a lot of concern about personal finances. In a situation like this where that concern exists, people tend to pull in. They spend their money on healthcare, rent, things of that nature. And, when we look at it, our brand health metrics are as strong as they have ever been. So we're pretty confident that once the consumer gets back into the game, if you will, that we'll be in a good spot.
There's no indications, Bill, that the Trump administration is going to pull back its views on immigration. It's pretty clear from everything you read, seemingly around the clock. So what does that mean for the longer-term outlook of your beer business?
I think the longer term will be fine because I think eventually the consumer will get comfortable with the new reality. Our expectation when you look at our business is our brands continue to perform. We gained share in 49 of 50 markets this year, so year to date. So our brands are doing very well, but the overall industry is a bit suppressed because of the lack of engagement and the lack of consumers going out and drinking and consuming in the way that they normally would.
You mentioned something on the earnings call, Bill, that I have not heard from you before. You said you're having, in California most notably, you're not seeing 4,000 calorie plus job seekers. Explain that to us, because it's something that I haven't heard from you before, and I haven't heard it really from a lot of consumer packaged good leaders.
It's an example of a way you talk about construction jobs. Construction jobs are subdued in the state of California. And those high intensity jobs often come with a beverage at the end of the day, and it often is beer. And as you know, that's our single biggest share market. So when the construction industry is soft and the impact to us is there's less consumption.
From your sense of talking to lawmakers in the state, is there anything they're doing to get more construction jobs that could feed into your business?
I think eventually that will pick up. When you've seen some of the examples of fires, for example, that oftentimes has taken longer than expected because of insurance claims and things of that nature. We would expect that would pick up. As you know, with the LA fires last year, there's a fair amount of construction that needs to be done. So over time, that should play itself out. But it's taken longer than everybody expected, particularly in the Los Angeles area.
You know, I think a lot of folks always focus on your beer business. I mean, it's a huge driver of your business, Bill, as you know full well. But you also operate a pretty large wine business. Some folks I've talked to in the wine industry of late have noted they're seeing challenges getting workers into the vineyards to pick the grapes because of some of these immigration policies that you were just talking about. What are you seeing at the vineyard level, and are we nearing out of stocks in wine?
No, I don't think we are at this point. Certainly not with our business. We are very comfortable with the amount of talent and employee capabilities that we have. And you know, it's played out in how our business has performed. You know, we've beaten the market now with our wine business for the last 6 months, and we actually had a positive depletion quarter this past quarter. So we're pretty optimistic about the future of our wine and spirits side. Acknowledging that there's some short-term impacts there as well.
There's so much competition in the wine business. What are you doing to cut through that clutter that you see when you go to the local beverage store?
Well, a number of things that we've done. First of all, Kim Crawford now is our biggest brand, and that's the strongest Sauvignon Blanc in the marketplace today. That's our single biggest brand. Mi Campo, which is a tequila that we started from scratch several years ago, has performed extraordinarily well in this current environment. You know, our focus continues to be putting products in the consumer's hands that they're going to enjoy. A number of our brands also play at the very high end. Things like Schrader and Sea Smoke are examples where they're in high demand. Frankly, demand outstrips supply in many instances. So, you know, our overall collection is really set up to win at a consumer level.
Consumers, Bill, they continue to drink less alcohol. I think it was a Gallup survey going around. I mean, they polled U.S. consumers at record low levels of drinking alcohol in this country. Is there a way to overcome that for a company like Constellation Brands?
Well, I think first of all, you need to think about the survey. If anybody asks you how much you drink, you may or may not tell the exact answer when somebody asks you the question. But putting that aside, you know, we continue to attract a younger consumer into our business. Our beer business, as an example, our percentage of Gen Z of our total business in beer is actually twice the industry average. So we've been able to bring people into the category. Some of that, one great example is Corona Sunbrew. You know, Sunbrew was just introduced this year. It's got a bit of real fruit juice in it. It's very refreshing, and it appeals to that consumer who wants higher flavor and good refreshment as well.
Coming up, we're looking at some of the top moving tickers Wednesday. Stick with us. Time now for some of today's trending tickers. Going to start here with AMD. AMD extending its 3-day winning streak. The stock enjoying a rally in the wake of a chip sale agreement with OpenAI. The two companies earlier announcing a multi-decade agreement to power next-generation AI infrastructure. Also, as part of the agreement, AMD issued OpenAI a warrant for up to 160 million shares of its common stock. Turning to Alcoa, Wells Fargo initiating coverage on that stock with an overweight rating. The firm setting a $40 price target on the name. This move coming ahead of Alcoa's Investor Day later in October, which could bring positive updates. And lastly, Confluent, the data streaming software maker, reportedly exploring a sale. According to Reuters, the firm is working with bankers after attracting interest from private equity and tech firms. Discussions are in their early stages, cautioning that no deal is guaranteed here. The shares rising in today's trade, helping to reverse some of the declines this year. Mizuho recently upgrading Occidental Petroleum from neutral to outperform, the move signaling a potential rotation back into traditional energy as balance sheets strengthen. We're navigating how to play the energy sector with the Yahoo Finance playbook. And joining me now is Nitin Kumar, Managing Director at Mizuho Americas. Nitin, it's good to see you. Let's start big picture, thinking about this energy sector, Nitin, because you say here in a note, you're emphasizing a divergence here, which is interesting. Oil softening, but gas fundamentals, you point out, strengthening. What explains this, Nitin? Walk us through these trends.
Sure. So, the story on the gas side has been pretty consistent for the last 3 or 4 years, which is increasing demand, both from LNG exports and power generation. And that continues to be the secular trend there. But what we've seen is that supply has been pretty strong in terms of the U.S. response, at least this year, and it still remains somewhat of a weather-dependent story. So investors who really kind of took a big tilt towards gas in the last 4 years are starting to think about whether they should maybe pare some of that exposure down. On the oil side, oil's been pretty, sideways. There was a lot of fear earlier this year as OPEC unwound some of their curtailments that we would see a glut of oil, but Brent has been pretty much in the $65 to $70 range for the whole year. What we're starting to see is that structurally, investors are thinking that perhaps we get another leg down here in the next 3 to 6 months, but longer term, as spare capacity is consumed by the market and there's a very tight inventory situation, you could see oil prices rise into the 26, 27 period. So we're starting to see a shift towards oil, to be honest about that. And so that's part of the reason that we took a look at Oxy here. It's a name that has some really good assets and is a little bit more oil levered.
Can I ask you another theme? I'm just curious. So consolidation has been a theme here, Nitin, in the sector you cover. Do you expect that to continue?
Scale matters. Shale has been sort of maturing over the last few years, where we've gone from resource acquisition or resource delineation to more resource exploitation. And what I mean by that is, you want to spread your fixed costs as over as much production as you can. So that's been part of the reason you've seen all of this consolidation. And so, yes, I do think that we'll continue to see the move in consolidation. There are a few opportunities. Specifically, a lot of the private entities with large scale have already been acquired, at least the ones that were available. You might see more sort of peer-to-peer in the public realm M&A, as I think management teams are trying to extract the most value for their molecule, and that means larger scale at this point.
President Trump likes to say, Nitin, you've heard this, it's a mantra, drill, baby, drill. Do you expect that? Do you expect that to see a meaningful uptick in domestic production?
Not really. This industry had a history of outspending cash flow for growth. And starting just a little bit before COVID in 2019, we started talking about this thing called Shale 3.0, but the idea was to sort of reduce the capital intensity of the sector, produce more free cash flow, and let people focus on the returns. We've seen that play out, and pretty much most companies are at best targeting low single-digit growth at this point. As I mentioned earlier, the private operators have mostly been consolidated. So now you have more assets in the hands of public E&Ps that have a dividend or a buyback program to support. So I don't think we're going to see a big wave of U.S. production, at least in the foreseeable future.
So we talked about the big themes and trends, and let's get to some picks here. First, start with ConocoPhillips. Why is that? Why are you telling clients that's a buy?
It's one of the best positioned and resource-rich companies in the sector. If you go down below the IOCs, Exxon and Chevron, Conoco has a really strong set of assets, both here domestically but also internationally. They are going through some big projects in Qatar on the LNG side, Port Arthur here in the U.S., Alaska on the oil side. as that spending starts rolling off, the company really starts inflecting on free cash flow, and they have a very strong track record of returning 45% of cash flow from operations to shareholders. So as that cash flow starts inflecting, we feel like the returns are favorable. We don't think the stock is cheap, and if you're looking for some exposure to oil, I think it's a good story to go after.
How about Expand Energy, Nitin, ticker EXE? It's up around 10% this year. What moves this one higher?
I think it's the stability. I mean, so we're not looking to get out of gas and go into oil, or we think a more balanced approach is what's called for here. The secular trends of LNG exports and power generation are still very much in the foreground. Expand doesn't have the deepest bench of inventory, but they have a good quality of resource. They have position in the Appalachia Basin. They have a position in the Haynesville, two of the best biggest areas of gas production. And what we like is the stability of their financial strategy. Some may call it risk averse, but what they do is they have a good balance sheet. They're paying down debt. They're accelerating debt reduction, which I think in a cyclical business is a good thing. They have a thoughtful cash return strategy beyond the dividend. And so I think they're well positioned if gas prices strengthen or at least remain at the levels they are. They have a pretty good story to tell.
Nitin, great to have you on the show today. Appreciate your time and those picks, sir.
Cheers.
We are wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.